Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, February 21st, and we got a lot of economic news releases to go over today. So let's jump right into it. We'll start off with the weekly jobless claims for this week, and we had 341,000 applying for unemployment last week. The forecast was to go up slightly up to 351, and actually exceeded that. So not a good direction we want to go, as we want to keep the weekly jobless claims lower. So we've actually went the opposite direction. And then we also have the leading indicators for January month, and we had back in December a 0.5% growth, and if we figure it'll come down a little bit, slow down a little bit, and it slowed down a little bit more than they anticipated. So not so good news so far. We had weekly jobless claims a little higher than we want. Leading indicators showing some less expansion. And then we got the core CPI, which is the inflation number for the consumer level. We had a 0.1% back in December. We figured it'd kind of go up a little bit in January, and we're up a whopping 0.3%. So this is a number we're going to really want to keep an eye on. The headline number actually came in pretty tame at basically at 0. So basically no change on the headline, but when you strip out the food and energy, we get the core. And this is a number we definitely want to keep an eye on. As remember, we talked about the mortgage-backed security or quantitative easing. They're going to be tying it towards the with the inflation as well as the unemployment. And as long as inflation stays in check, as long as it doesn't go climb up more than 2.5%, we'll be okay. And then wait till inflation or unemployment comes down to about the 6.5 levels where they like to be. So this is again, this could put us on pace to be above that if we keep this pacer. So again, next month we want to see if there's an anomaly or if this is going to be something that's going to be continuing, and we're going to have issues with inflation, as that's typically when the Fed will usually fight inflation by raising interest rates. We had the market flash PMI, which is the Purchasing Merchandising Index. And for the month of February, we had a 55.8, which is anything above 50 is expansion. We figured it was going to slow down a little bit, and it slowed down slightly more than we anticipated. Not the worst case scenario, but not the best either, because it went obviously in a different direction. We want to kind of keep an eye on that. And then we also have existing home sales for the month of January, which we had 4.9 million. We figured it would be the same thing, but we got some good news at 4.92 million. So slightly more than we anticipated for the existing home sales. And then also we got the Philly Fed. What that is, it's the manufacturing in the Philadelphia region. So we had some contraction in the month of January at 5.8. We figured it would start climbing out a little bit in the month of February, and actually contracted further. So obviously not good news at that level. And also remember yesterday we had the Fed minutes release. So the stock market had started going up a little bit, and then when they started going through the minutes, it worsened, and then started improving the bond market. And same thing with the bond market. The bond market was worsening, and then after the minutes, in anticipation of it, and then they came out and started improving a little bit because the money from the stock market was going into the bond market. So kind of stuff that they're reading into is that basically the Fed really doesn't know which direction the economy is going into. They don't know if the stimulus applications that they're applying, like the quantitative easing, how that's really affecting the economy, where it's going, if it's really doing much effect, if it has much effect. There's concerns that with all these asset purchases or debt purchases of the treasuries and the mortgage-backed securities, that maybe they're exposing themselves too much and creating another bubble coming out there. So there's been a lot of talk on that, and we'll go over to headline news here. And one of the Fed members, which will stock market's down, but one of the Fed members is the Dallas Fed member, Fisher. He spoke today basically saying that he believes that the Fed's going to gradually pull back or phase it out versus just immediately halt on there. So to touch back on the previous item here, Europe PMI worsened. So obviously we were there was some optimism that maybe Europe isn't as bad of a situation as we thought, but it looks like with this, the PMI worsened. So economy is obviously not doing as well as we anticipate. So there's still a lot of issues going on in Europe right now, and it's not creating a whole lot of optimism on the market right now. So hence, with all that combined from the fundamental standpoint and well as the technical standpoint, the stock market's down currently today. So let's see how this is playing out in the bond market. And actually, we're getting a nice little rally here. We're up we're about 12 basis points for the day. We're up to 103.03 right now. And if we can remain above the 103, we have some room here where we could keep probably within this range here. We'll be back to this range. We might see some improvement, continuation of the improvement in the interest rates. So we got to get above here the 10-day moving average. As we see, the 10-day moving average came down. So we want to obviously get this up further and see continuation of the improvement in the interest rate. So this could be a beginning of the correction, as we've been kind of waiting for, or it might be just you know, a slight one for the bigger correction in the meantime. All right, so we got an improvement in the interest rates today. Let's hope that we again close above the 103 level, which could bode well for us, which will create a floor support for us, and hopefully bounces higher on the bond market for improvement in the interest rates. All right, folks, thanks for watching. Hope you guys have a wonderful day. Sorry for the long thing, but we had a lot today to go over. Tomorrow will be a lot slower as we don't have any economic news releases. So we'll be more on the technical side of things. You guys have a wonderful day. We'll see you guys tomorrow.